Can everybody hear me from the lapel mic okay? Well, first of all, I would like to thank you for having me here. I'm honored to be a part of this organization. I'm also a little bit angry, though, at the protocol that must be observed in Botswana because, you know, I had a very good speech prepared. First, I was going to talk about the importance of SMEs for growth, and then, of course, the chairman spoke about the importance for SMEs for growth. Then I thought, okay, well, for sure, I can talk about the importance of nurturing entrepreneurship and the private sector in general, but then, Mr. Vice President, you spoke about that. Then I thought, okay, well, for sure, what I will talk about is the importance of the middle class and African demographics, but again, you know, the Vice President took that from me. Then I thought, okay, for sure, macroeconomic stability, the importance of developing capital markets, but again, Mr. Vice President, you took my punchline. So now I think I will just sit down if nobody minds, and I will go back, maybe go have a nap in my room. So when Thapelo asked me to speak here, he said, you know, please talk about the importance of SMEs. And I thought to myself, well, there are 400 people coming to this conference. They wouldn't be coming here if they didn't think SMEs were important. But still, the numbers are absolutely staggering. So I thought I might just go through them a little bit to talk about it. But before I start, can I just ask, how many in the audience are business owners or work in business, looking to raise capital? No business owners at all in the audience? Can I just raise your hands? Okay, terrific. How many people here are government officials, regulators, somehow involved in the public sector? Okay, a few. How many would consider yourselves sort of banks or intermediaries or somehow involved in capital markets? Okay, great. And how many here are investors? Okay, if the investors could stand up, please, so everybody could see exactly who you are, that would be useful. Okay, so, okay, 917. Okay, so I won't read all of these numbers to you, but it is true. The numbers are absolutely staggering as to how important SMEs are for the economy, not just in developing countries, not just in middle-income countries, but all over the world. In the United States, for example, they account for 55% of all jobs and 66% since the 1970s. The IBRD did a study and said globally they are about 90% of the number of businesses in their markets in the European area. There are 67% of EU employment. And of course, in developing countries, there are about 45% of employment and 33% of GDP. Now, part of the reason that there's such a large percentage of total businesses, of course, is that they're small. So the real important thing is that they become a large and significant and accountable part of GDP. And how does that happen? And that only happens, of course, through SME growth. And what is the most one of the most important constraints for GDP growth is, of course, access to credit, which, again, has already been, unfortunately, already mentioned. But in developing countries, it's about a $1 trillion gap in credit for SMEs. So we've got a lot of work to do to get that money through capital markets to the SME sector. It is the most important constraint to growth in middle-income countries. And it is the second most important constraint to SME growth in developing countries. Does anybody know what the most important constraint to growth is for SMEs in developing countries? Anybody guess? No? Electricity. Electricity. And you know, I even gave you little lightning bolts there to help you guess, but okay, electricity. But access to credit is the number two. And despite a low interest rate environment globally since the global financial crisis, the credit box for SMEs has actually tightened globally. And that's because of bank deleveraging, because of stricter prudential guidelines. But even more than that, bank finance structurally is not the most appropriate kind of finance for SMEs because bank finance requires collateral. It's not appropriate for high growth, non-capital intensive industries, which is a lot of the service industries and SMEs globally, how they focus on. And so you need to find other ways of getting credit to SMEs or capital to SMEs. And if you can do so, then you can add something like 10 to 20 basis points of GDP growth annually and generate hundreds of thousands of new jobs. So it's worth pursuing. And you know, as they say, there's a broad consensus now in a sort of public policy and in the development community and in the aid community of, well, maybe I'll ask you, what is the #1 most effective dollar spent on kind of developing country middle income growth? What should it be spent on? Does anybody know? Broad consensus on this. Education of young girls. This is, Women's Day, right? I'm carrying International Women's Day over one more day. It's the education of young girls. But if I thought about taking that same kind of philosophy toward thinking about the private sector, I would say the most important development challenge and the most important challenge for policymakers is the development of capital markets and widening that credit aperture for small and medium industry, because again, you're looking for private sector-led growth. You're looking for growth coming from the natural dynamism of, and in particular, given Africa's demographics that you can find on the continent. So a lot of things are now happening to think about, to think about that. The better development of private markets and venture capital, more thinking about non-bank finance, asset-backed securitization, trade finance, that kind of thing. Fintech solutions, crowdfunding, online lending platforms, and I'll talk a little bit about that in our panel. And then, of course, bringing SMEs to public equity markets. And so that's what I will focus on mostly in this talk. So one thing that has really been discussed a lot recently, and when we were doing a capital markets master plan project for Rwanda, it occurred to me that nobody's really done any good empirical research on this. But one of the things that's been quite popular lately are SME dedicated exchanges. So, and feeder exchanges into stock exchange main boards. 20 of those have been developed recently, and they've all been globally, and they've all been basically developed in the last 20 years. And you as well have a VC board, I think, as well. And the idea of these kind of special attention to SMEs, either on the main board or on a separate exchange, is that you kind of lower the requirements a little bit, and you enable and you do a bunch more hand-holding, the kinds of things that Tapelo was talking about in the video, about really, you'll be happy to know that in Botswana, they're doing a lot of these things. Becoming a feeder mechanism, holding hands to kind of get these small companies ready and go that extra distance. Now, of course, you know the benefits of listing, or you wouldn't be here at this conference. But the idea is not that you get funding from listing itself. It's not just the equity funding. It's that the process of listing and being a public company and demonstrating that you have good corporate governance, demonstrating that you have good finances will enable you later on to get other kinds of funding as you go forward. And that comes from the reputational gains and the exposure that you get from being on a stock exchange like the BSC, and it comes from just the fact that you have become a better economy. Now, from a company. So that's from the kind of the micro point of view, and from a macro point of view, it's also very important for overall capital markets development. Why? Because first, it enables private markets for SMEs to develop, because private investors don't invest. I mean, you go see a venture capital fund or a private equity fund, and the first word that comes out of their mouth is exit. How do I get out of this investment, right? So you can't have that, thank you, without, I've been having a bit of a cold lately, so I'm a little scratchy, thank you. So you can't make an investment unless you're sure that you can get out of an investment. That's why these public markets are so important. And secondly, savers that are now earning nothing in their bank account deposits, they're not going to lend money on term because they don't know when they need their savings back. So this is a very important mechanism to equity investment, that you can get a higher return on your savings, but you also have that liquidity so that you can get your money out when you need it. So both from a micro and from a macro point of view, it's a very important thing. But there are, of course, costs. There's a pain in the ass to list. Everybody knows that. It's also quite costly in certain ways. There's fees, there's ongoing fees. You got to pay intermediaries. And, and it's also risky. It's risky to companies to list. It's a bit scary. First of all, you can lose operational control. It's always a possibility. And even if you maintain a majority and you're not worried about that, well, then you have, pesky shareholders that you have to answer to. You've got this public scrutiny. You could end up on the front page of the paper. You also have trading volatility that can come when investors have a more short-term view than you have, even though you've just been running your business the way you always have, and investors are sort of trading in and out of your stock. It can be very disconcerting. So what we wanted to do is actually take a look empirically at the Milken Institute, and I have 3 people working for me on this paper for a year. And what we did was we looked at, and I put their pictures up because they're unhappy that they can't be here with me. We took a look at 3 countries. India, the Bombay Stock Exchange, which is the stock exchange for SMEs. We looked at listed companies and unlisted companies. We looked at the South African exchange, both the main board and the Alt-X board. Again, sort of half listed and unlisted. And then the Jamaica Stock Exchange, listed and unlisted SMEs. And we did this because we wanted, first, geographic diversity, but second, because these are considered very well-performing SME exchanges. So there's something to be learned. And these guys, we really got our dirt under our fingernails in this work because we did surveys and we followed up with phone calls and we talked to company CEOs. We also interviewed exchange officials, and we have a number of very interesting findings that come out of it. So the first thing that we asked is, I've just listed the benefits of going public. When companies list, are those the same benefits that they are thinking about? When they list, why are they making that decision to list? So this is my favorite slide in the whole deck, actually. So first of all, so we have here in the blue the SME platform, and then the main platform at first for India, and then for Johannesburg Exchange, and then for Jamaica. Basically, you don't have to look at the numbers, just the bigger the bar, the sort of more important it is. That's just the basic idea I want you to get. So first of all, if you look at kind of enhancing, so for everybody wants to, how am I doing this? Everybody wants to raise capital at a lower cost, okay? So those are big. So everybody knows why they're listing. Interestingly, I thought in India, they really need to enhance creditworthiness. And I think that's because it's such a big SME market. Indian small companies are looking for a way in particular to differentiate themselves. And nothing does a better job of differentiating yourself than being on a stock exchange. It's a way of saying, hey, I'm different from my neighbor because I was willing to go through these things. Okay, but what I think is just beautiful about this slide is that everybody wants to raise capital at a lower cost, but nobody wants to improve their financial reporting and transparency. See how small those are? So, I feel like, for exchanges, that's a very good opportunity for you as part of your outreach, as part of your marketing, to make that connection that the only way you are going to raise capital on a consistent basis is if you improve your financial reporting and transparency. So that's a bit of a takeaway for you guys, to make sure you keep making that fundamental underlying message, because I would love to be in the Olympics. I just don't want to, train every day for it. And then also I think companies are aware, they're very aware of the other benefits that come from listing, how it helps position the firm for growth. Look how long those lines are, how it helps increase their competitive advantage versus their competitors, how it improves their brand and visibility, and in Jamaica they do give tax breaks, and I'll talk a little bit about that later. But it's not just about raising money, these other things are quite important. Now, the second question we asked was, okay, we know the benefits, we know that companies are aware of the benefits and they invest for that reason, but are their expectations met when they actually, are they positively surprised, which is your green, or are they negatively surprised, which is their red? And so you can see, I'm not going to take you through all of this, but basically their expectations are, and then here the expectations things are kind of on the right, left here, which is sort of impact on visibility, effect on financial performance. So you can see there's a lot of green and a lot of yellow. So these exchanges have done a pretty good job of being what companies think they ought to be. Interestingly, the SME boards, SME dedicated exchanges do a better job. So in every line, for every country, the SME board is on top, and the second line is the main board for that country. So the first one is India, the second one is Johannesburg, and then as it goes down like that. So look, loss of company control. The SME board did a much better job of explaining to companies what that actually meant. Shareholder pressure. Again, the SME board does a much better job of explaining that according to investors, according to companies, I mean. And then the same thing on public scrutiny. Again, these SME boards that take the time to work with companies to hold their hand, it shows because the companies, they understand and they feel that they're quite well prepared when they get to the board. The Jamaican board in particular really promotes awareness. They spend a lot of time, and even I will say, as we did our survey, it was the easiest country to do the survey in because the board was in constant contact with its companies, and it could really help us do the surveys. And so these are all, I don't know if you can see them, but they're all sort of questions about advantages and disadvantages of listing. Are you aware? And you know, this is that first one. Every board is pretty good. All of the companies are aware. What's the next one? The listing process. Are you aware of what that is? The costs of going public. Are you aware? The lowest for every exchange was the ongoing costs of listing. And we found that companies were very aware of the cost of getting an IPO, but they were a little bit surprised by how onerous it was to every year to keep having fees. So that's another takeaway to maybe make sure that's a little bit clearer. But anyway, the Jamaican companies were the most aware, and no surprise when we asked them, would you list again, knowing what you know now? These are all listed companies. Would you list again? In India, only 64% were. So what they thought was going to be the advantages, they're not sure those advantages panned out. In South Africa, again, you know, about 57 to 60%. But in Jamaica, 87%. And part of that is because they get some corporate tax relief. This turns out to be a bit of a headache as well, but this corporate tax relief does help encourage listings. But they felt like they understood, they were not surprised. If they were surprised, they were surprised on the upside, and that means that they would all make those decisions again if they were asked again. But at the end of the day, the most important thing really is getting access to finance. And that, again, you know, you can't read all of this, but the most important thing is to understand that top bar, which is medium-term bank finance, is very strong for each of these exchanges. And it shows that these companies said, yes, the fact that we're a listed company, even if we prefer credit to equity, the fact that we're a listed company helps us going forward getting that access to finance that gives us our kind of bread and butter working capital, et cetera. So some of the key takeaways from the listed firm's experience are that they do appreciate the benefits of listing, but they don't like surprises. That hand-holding does matter, but that more can be done, especially between the link between good governance and financial reporting and access to capital. Tax incentives can help if they're structured in a certain way, which I won't get into the details of that, but there are sort of interesting tax implications. And that public listing does in fact help. These companies were vehemently saying that having been listed did help them get other kinds of finance. So then we talked to unlisted firms. And what matters for unlisted firms is your perception of the exchange. So for you guys running exchanges and you guys trying to encourage companies to list, it's that perception of what it means to be a public company in your country that drives everything. So in India, the top 5 perceptions are actually negative. So we interviewed companies that have not listed, that qualified for listing but did not. There's a lot of shareholder pressure, there's loss of company control, that there's, you know, it's costly to list, there's a lot of share price volatility, you've got to do all this financial record keeping. All of that means, you know, 68% of them are kind of unsure if they would list, and 32% said no, they wouldn't list. Okay, so, you know, of course, if you talk to unlisted firms, basically they're not going to list, because if they wanted to list, they'd be listed. But, you know, we're just trying to get at the reasons why that is. Now, if you've got some perceived access to finance despite that, then it helps. So in South Africa, again, lots of negatives: shareholder pressure, loss of company control, you know, how liquid will the share trading be, time and cost of meeting these requirements. But, you know, this enhanced access to capital is in there in the top 3, and that's very important. So you get about 9% saying they won't list, but about 19% saying yes, they would consider listing. Most are unsure. In Jamaica, as they say, branding is everything. Very clear idea in Jamaica of what it means to be a public company and how that can benefit your reputation. Positive impact on brand and reputation, 90% of them. Then enhanced access to finance, and then some negatives, right? But the idea that being a public company in that market means something, and everybody knows it, means that 83. I mean, this result isn't even close to the other two market results. And this is not to promote the Jamaican Stock Exchange per se, but they do, it's a small place and they do a lot. They're a very active exchange. 83%, no negatives, and only 17% unsure. So some of the lessons for attracting is that, outreach and awareness efforts are working. All of these exchanges do have a good sense of what is required for listing and what is needed. But they do need to know, as I said before, a bit more about kind of the ongoing requirements. And this might seem completely obvious, but when unlisted firms have a positive view of what going public means, then they're more likely to want to go public. I know that's a very profound statement. But in particular, if they have a sense that it's better for their brand and it will help them get ongoing finance in the medium term, that's a very important consideration in their head for how they're thinking about it. Just one slide before I wrap up on graduates. I can't explain this finding. I have it up here, but I really don't understand it. Is that in India and in Jamaica, you must graduate if you meet certain criteria onto the main board. And in South Africa, you can stay on the SME board as long as you want. And for some reason, everybody on the South African board wants to graduate. It is graduating, and everybody much more than the other two boards. So I don't know why that is. Okay, so let me end by collecting some of the success factors that came out of the survey and some work that the World Bank and the World Federation of Exchanges has done, and ask yourself on your exchange, whether you meet some of this criteria. In red, the exchange has a lot of control over those things, and in orange has some control. In black, you don't really have that much control. So good timing is very important. So the Bombay Stock Exchange started when there was a big credit crunch in India, but also a lot of growth in India. So it was a great time to start an exchange. That can be very important. You have to have a dynamic SME base. You need government commitment, which Botswana clearly does from the fact that my entire speech was stolen from me. Government commitment to the sector, an equity culture. And I think, in the countries in Africa that I do advisory work on capital market development and pro-growth policies, and a lot of the countries that I work with are very much have this kind of equity culture. And then a legal connection to the main board of a stock exchange turns out to be very important. These feeder exchanges are much more successful than standalone SME exchanges, actually. Okay, so in terms of issuers, again, the focus should be on high growth SMEs. Reduction of listing cost is obviously very important. One thing that we also found, this mimics some World Federation of Exchanges research, that you can have kind of more onerous listing requirements, but it's better if you make them less frequent than if you make them less onerous. So what companies really object to is just the constant reporting and the constant updating. They say, not that much changes really. So they don't mind, but they just kind of don't want to do it as often as on the main board. So that might be something to think about in terms of policy. All these SMEs are very electronic, and so they like the idea of being able to post reports online and use technology. And to the extent that the exchange can also fund outreach and awareness, I can't emphasize how important that is. And then last, for intermediaries and investors, the use of authorized investors is advisors, is very important actually to helping us. It's part of this hand-holding process that can be quite important. Subsidized research, this is what we're trying to figure out here is how to close that kind of those information gaps. And so helping subsidize that research so that companies know that they will get that brand recognition if they list is critical. Strong retail investor base, some tax incentives, and you have to have some kind of a minimum level of liquidity. And the idea of that, of course, is that you get into a virtuous circle, and I just will end with sort of some thoughts on that. So what you want to do is you want to get yourself into this kind of virtual upward circle whereby you've got enough companies listing, and so that you get liquidity on your exchange, and getting liquidity on your exchange means that you have less kind of share price volatility and more folks want to list, and investors know that they can get out, and so they're more likely to invest, and that has share prices going up. And if you think about that at the level of the exchange, that means that capital markets are developing. And I cannot emphasize enough the importance of focusing on developing domestic capital markets, and especially now, right? You've got, Africa's in a bit, unfortunately, of a bit of a vice right now. Commodity prices, they're starting to crawl back up a little bit, but they're very uncertain and they're in low levels. And you've got China, no longer growing at 12%, it's growing at 6.5%. And you've got, this knucklehead in the United States creating all kinds of, uncertainty, and interest rates also might be going up and probably will be going up in the United States. And so African countries that are running their economies very well might get a bit caught up in this. And the best way to protect against that is deep, liquid, domestic, and regional capital markets, whereby the private sector can be the engine of growth. And who can fund that engine of growth? Households. So that it is a win-win. You're no longer having households putting their money in deposits, earning absolutely nothing, while, no disrespect to banks, banks are kind of buying government paper. Whereas you can put this kind of, and as African pension funds also get larger and larger, you can put these savings resources towards the most productive investments in the economy, create this virtual circle of growth, and then you're kind of off to the races, really. So there's a lot to do, so I hope in this conference we can roll up our sleeves and get working, and thank you very much for your attention.